Okay, I guess we'll get started. We got a very small class, so you guys can ask a lot of questions, and hopefully we'll get all your questions answered. The reason I wanted to talk about real estate or residential bridge loans is because I get a lot of calls from realtors and clients asking for bridge loans, and I'm not sure they have a full understanding of what a bridge loan really is and why we need them. Um, Frankly, we try to avoid them. It's kind of a loan of last resort, but sometimes you need, so we're going to go through when not to use them and when they are appropriate. Okay. See. Just come up with a definition of a bridge loan. This is the best one I could find. A residential bridge loan is a temporary financing solution secured by the borrower's existing residence and or the new property being purchased that allows the borrower to access equity before their current home is sold. So it is truly for buying before you sell. I mean, that's what a bridge loan is all about. That's the only time we ever really use them in residential real estate. And the funds that we take out of the departing resident is used for the down payment and closing cost on a new home. Some of the features, they are very short term. Most of them don't even last 6 months. Depends on how long it takes to sell your current residence. There is no prepayment penalty of any kind. So, in fact, the lender probably wants you to pay it off so they can churn the money. The collateral that we typically secure the existing home at the very least, but we can also do what's called cross collateralization and collateralize both properties, where we collateralize the home you're buying and the home that you plan to sell. And it's all in one loan. So the purpose, again, is to cover the down payment, closing cost, and mortgage payments in some cases on the new home while waiting for the old home to sell. So you can actually get a little bit of extra equity to help with the cash flow of having to make two mortgage payments. The repayment is real simple. It's paid off when the borrower sells their current home and refinances that home. Or transitions into permanent financing. Maybe they decide just to keep their current home and you just do a refinancing. The negative of bridge loans is they have a much higher cost because they're short-term loans. The bank's not going to have the loan for very long. So the interest rates are higher, the fees are higher than a standard mortgage just because of the short-term nature. The bank has to make money in a much shorter period of time. However, on most bridge loans, the principal, interest, taxes, and insurance of the current home is not considered or used when you're qualifying for the new home. So we pretend that loan or that home doesn't exist, that debt doesn't exist. And that's the real reason for using bridge loans, is where you can't qualify with any other loan. Okay, so I'm going to go through a scenario, and again, just unmute if you want to ask a question or pop it into the chat, and Alex will stop me and ask questions. So let me go through kind of a typical scenario when people are buying before they sell. So let's say a couple has a current home with a value of $1 million, and they have a balance of $500,000. Their current principal and interest payment is $33.26. Taxes and insurance might be another $600. So their total PITI is just under $4,000. So we can normally, what we would want to do is go to that home, get a home equity line of credit for, let's say, $300,000, and lines of credit are normally at prime plus one, so prime's at 7.5, so you should expect a rate of like 8.5%, although the banks do have teaser rates, but let's just use that as the example. So you would add, and that's an interest-only payment, so you would add another $2,125 a month in payments. So the current home, the departing residence, once you get the home equity line of credit, you would have a total housing cost of $6,051. And then you would just simply go buy the new home using the money from the line of credit. So in this case, let's say they're buying a home for 1.25 million. After paying closing costs, they would need to get a loan of about $970,000, and let's say it's at about 6.5%, which is about where the rates are today. And the principal and interest payment would be $6,131. And let's just say, for example, taxes and insurance are $700 a month. So their new home is going to have principal, interest, tax, and insurance of $6,831. So now, if you look at the situation, they went from paying about $4,000 a month in total housing payment to now they're carrying two homes with a total of $12,882. So to do this conventionally, they've got to have pretty good income, So this would require somewhere between $260,000 to $340,000 a year in annual income to qualify for those two loans. And the difference is we can use what the departing residents would rent for as additional income to qualify. So in this case, you would only need, if you use the rent from the home that you were leaving, you would get 75% of whatever it rents for, and that would reduce your annual income requirement to $260,000. So the problem is, if a person doesn't have $260,000, then we start looking for ways to get around that, and again, we don't go to bridge loans first. We would go to, maybe they're self-employed. We can do a bank statement loan. Maybe we could do a profit and loss statement loan, or maybe they could bring a family member into the transaction as a non-occupying co-borrower, and that would bring their income up enough to do this deal. Those are the things we would look at first. If none of that works and they really want to buy this new home, that's when we look at bridge loans, okay? And you're going to see they're much more complicated and they're more expensive. So we always try to go conventional first, or adding non-QM loans like bank statement loans, DSCR loans, those kinds of things, before we take a look at bridge loans. But we do quite a few bridge loans. And so I'm going to go through the different types. And there's fundamentally three different types that I know of in the market. Each lender's a little different, but there's probably a dozen lenders that I know of that offer bridge loans, so they're not very prevalent. And most of them are on the mainland. So let's look at the two types of bridge loans. So the first one is where we cross-collateralize both the departing residence and the new home. So the lender provides a single loan to pay off the current mortgage on the departing residence and enough money to purchase the new home. Or maybe the client has to come in with a little extra cash, but the lender is providing as much as they can by securing both properties. The borrower qualifies on what we expect the future loan to be once the current home is sold and the bridge loan is paid off. So they're not qualifying for the bridge loan itself. It's probably too big of a loan for them, but the lender is saying, okay, well, they're going to sell their house. Let's be kind of conservative, and we'll assume, it takes, 6 months, and they've got enough money to carry the loan for 6 months because it's an interest-only loan. But they don't force them to qualify based on the full loan amount of the bridge loan, only what's going to be left over once they sell their house, their departing residence. The other types of bridge loans is where we go out and get two loans. One is a bridge loan that is placed on the departing residence to pay off the current mortgage and to provide the down payment for the new home. A new conventional loan then can be used to purchase the new home. But when we underwrite the new loan on the new property, we don't take into consideration the payment on the bridge loan. It's not even considered in the qualifying of the new conventional loan. So a lot of lenders won't do this. They would always, most lenders are going to look at all of the debt that a client has, including the bridge loan. But we have lenders that underwrite specifically by offering a bridge loan in their portfolio and then offering the purchase loan on the new home. Okay. So those are the two different types, and I'm going to give you three different scenarios. So let's start by this cross collateralization bridge loan. This is certainly the best way to go. It's the cheapest and it's the easiest. So let's say the departing residence has $1 million value and a loan of $500,000. The new home that they're purchasing is $1.25 million. So there's total collateral of $2,250,000. Now, depending on the lender, you can probably get up to about 75% of the combined values in a single loan. So in this case, 75% of 2.25 million is 1,687,500. The rate today on that bridge loan is 8%. In addition, you have to pay 2.75% in points. So it is expensive. It's got a higher interest rate. But they do make, you only have to make an interest-only payment. So in this case, it'd be $11,250 a month. Okay? Now, again, they're not qualifying the client on the $1,687,000 loan. They're going to qualify them on what the residual loan will be when they sell the house. So out of that $1,687,000, we're going to pay off the current balance. That leaves $1,187,500 for the new purchase. The buyer would still have to come in with a little bit of cash, can even be from a family member, and closing cost. But remember that the buyer has to qualify, in this case, for about a minimum of a $750,000 loan. And we do the calculations right then and there at market rates to say, yeah, when they sell the departing residence, they're going to be left with a loan less than $750,000, and they qualify for that. So this is probably the best loan, the one I go to first, because it's easier, and you're going to see another very complicated loan, but it's easier. It's not cheap, but it's easy. It's easy to get done. Okay, and it's one loan. It just goes through underwriting once, and it's pretty simple. So, any questions about this cross-collateralized bridge loan? Okay, no questions. Okay, all right. Let's look at the other types of bridge loans. I'm going to give you two different kinds that I know of. So the first one is a little more complicated. It works really well. It sounds scary at first, but it's not that scary. So again, we put a bridge loan on the departing residence. So let's say it's $1 million value, $500,000 loan to be paid off by the bridge loan. The bridge loan can go up to 75%. So the client cash out about $250,000 in this case out of the bridge loan. Now this is interesting. The bridge loan has a 0% interest rate, and the lender gets paid a 2.4 commission that's due upon the sale of the departing residence. So that's what they get paid. So it's a no interest loan, and the lender doesn't get paid until you sell the house. However, this loan requires the borrower to sign a guaranteed backup contract to sell their departing residence to the lender at a sales price of about 75% of the fair market value. Okay, now the borrower has 28 days to get the home listed after they buy their new home, a time to get it fixed up. and then 120 days after that to sell the current residence. So it's a total of 148 days that the borrower has to sell their home. If they don't sell it, the lender could exercise their right to buy that home, and it's at a discount. Now, as far as I know, they've never exercised their right, at least last I heard, and they do lots of these. And the reason is, if my client signed this deal, I would immediately structure a takeout loan that if they didn't sell their house in 148 days, that we would have another loan set up to bridge them further. And usually you're looking at a hard money loan. There are other types of loans that we could get into, but I would probably make sure to protect the buyer, the client, by having a backup loan set in place to close before the 148 days expires. And we can do that. I mean, it's pretty easy to do. Okay. So it's a pretty complicated loan, but it does work. And the home can be, and by the way, I want to go back to this other loan here. On this cross-collateralized bridge loan, both properties have to be in Hawaii. So this is only for people that are selling a home in Hawaii and buying a home in Hawaii. These loans that we're going through, the homes can be anywhere. You can be selling a home in Connecticut and buying a home in California, for that matter. It doesn't really matter. So in the case of Hawaii, if you have a client that is leaving California and moving to Hawaii, we can place the bridge loan on the California home and then have the new loan on the Hawaii loan. So on the new residence that they're buying, it's just a standard mortgage. It's, let's say it's a $1.25 million purchase. The down payment is $250,000. You get a loan amount of $1 million. Again, you might have to come in with some closing costs, and you have a principal and interest payment of, let's say $6,320. But again, on this loan, the lender is not going to count the bridge loan when they're qualifying the client for the new residence. That's so important. So the same lender is offering both loans, so that it's kind of being underwritten once. But the buyer, the borrower has to sign that guaranteed backup contract. Okay, so that's one type. It sounds a little scary, but we've had clients do them, and they've made it through perfectly and gotten their home sold. It does provide a pretty good incentive to market the home, but and again, they lean on me to have a backup plan, so they're not going to lose the 25% in their house. Okay, any questions on this one? I figured I'd get questions on this. Okay, let's go to the other type of bridge loan. This one does not require a contract for the sale of the home, but it's a little more expensive. Okay, so again, if the bridge loan is placed on the departing residence, the departing residence can be anywhere in the United States. Let's say in this case it had $1 million of value, $500,000 loan. We get a bridge loan of $750,000. There's a cash out for the down payment of $250,000. Now in this case, while they don't require a guarantee, and you're getting a 0% interest rate on the previous loan type, this one is 9% interest on the bridge loan. You don't have to make any payments until the home sells, and there's 4 points in fees. So it's, that the lender's making money right up front. It is due in 12 months, so you don't have to rush to sell your house, and you don't have to make any payments on it. So, and every lender's got a little bit different play to their bridge loans, but these were two good examples of different types of bridge loans that we've used in the past and gotten clients. And then once you have the bridge loan in place, again, you're getting the bridge loan and the new loan from the same lender. You just get a conventional loan of $1 million. The current residence is not counted. That bridge loan on the current residence is not counted when qualifying for the new residence. So again, when we take, and those are two or three good examples of bridge loans. I mainly do the cross-collateralized loan. Those are, again, cheaper and easier. And those are, that's the loan that we normally go to. These other two loans are obviously more complicated because it does involve two loans, and they are more expensive. But if somebody really finds a deal that they really want to get into and they don't normally qualify to buy before you sell, these options will provide them that opportunity, is to buy before you sell. So that's what I have for you. I'd like just to open it up for questions, and if you have anything that I didn't explain very well. Sydney, do you have any questions?
No.
It's not used very often, but the thing that it's important that almost every buyer out there, if they have a current home and they want to buy a new home before they sell their old home, I mean, you can almost guarantee you can get them into it, unless they're just over purchasing. But there's so many people that think that they have to wait to sell their home, or they have to get into a contingent contract where the seller agrees to wait until they sell their current home in order to close on the new purchase. So this eliminates that, contingency for a purchase contract. So it eliminates that problem that, a lot of sellers are going to have when they look at an offer that is contingent upon the sale of the person's home. Now, this doesn't mean that, the buyer could put their property on the market, and if it sells before we have to close on this new product, and all the better. All right. Thanks a lot, everybody. Thanks for joining us.